Hey guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of the video is how to pay 0% capital gains tax legally in the US 2025. When you sell a stock, mutual fund, investment property or a business, if you have made money on that investment, the IRS is kindly waiting for a piece of that gain in the form of capital gains tax. Capital gains are taxed differently than the ordinary income tax that you received via your paycheck or pass-through income from your business. Unlike ordinary income, which has a series of tax brackets that range from 10% to 37% in 2025, capital gain income is taxed at a flat rate at the federal level. Most taxpayers are aware of the 15% long-term capital gains tax rate, but very few know about the 0% capital gain tax rate and how to properly time the scale of your invest to escape having to pay the tax on the gain. What is the difference between short-term versus long-term gains? Before I get into the tax strategy, you will first have to understand the difference between short-term and long-term capital gains. Short-term capital gains apply to any investment that you bought and sold in less than a 12 months period. For example, if I buy a stock today for $1,000 and I sell it after 3 months for $3,000, I would have a $2,000 short-term capital gain. Short-term capital gain are taxed as ordinary income like your paychecks. There is no special tax treatment for short-term capital gains and the 0% tax strategy does not apply. Long-term capital gains, on the other hand, are for investment that you bought and then sold more than 12 months later. When I say investments, then I'm using that in a broad term. It could be a business, investment property, or a stock, etc. When you sell these investment at a gain and you have satisfied the 1 year holding period, you receive the benefit of paying tax on the gain at the preferential long-term capital gains rate. So, what are the long-term capital gains rate? For federal tax purposes, there are three long-term capital gains rate. First one is 0%, then 15%, and the last one is 20%. So what rates you pay is determined by your filing status and level of your taxable income in the year that you sold the investment, subject to the long-term capital gains tax. For 2025, below are the capital gains bracket for single filers and joint filers. So these are rates of 0% rate, 15% rate, and then 20% rate. As you will see on the chart, if you are a single filer and your taxable income is below $48,350 or a joint filer with a taxable income below $96,700, all or a portion of your long-term capital gain income may qualify for the federal 0% capital gains rate. An important note about state taxes on capital gain income is that each state has a different way of handling capital gains income. New York State is a no mercy state, meaning they do not offer a special tax rate for a long term capital gains. For NYS income tax purposes, your long term capital gains are taxed as ordinary income. But let's continue our story with the Fed tax rule, which are typically the line shares of tax liability. In a straightforward example, assume you live in New York, you are married, and your total taxable income for the year is $50,000. If you realize 25,000 in our long-term capital gains, you will not pay any federal tax on the $25,000 in capital gains income, but you will have to pay NYS income tax on the $25,000. Then don't stop reading this article if your taxable income is above the thresholds. For many taxpayers, their income is well above these income thresholds, but I have a good news with some. maneuvering. There are legit strategies that may allow you to take advantages of 0% long-term capital gains tax rate even if your taxable income is above the $48,350 single filer as a single filer and $96,700 as a joint filer threshold. I will include multiple examples below as to how our high net worth clients are able to access the 0% long term capital gain rates. But I first have to build the foundation as to how it all works. So, first of all, using 401k contribution to lower your income taxable income in the years that you will have long-term capital gains. These are strategies you can use to reduce your taxable income to get under the 0% threshold. Here is an example. I had a client sell all rental property this year and the sale triggered as a long-term capital gain for $40,000. They were married and had a combined income of $110,000. If they did nothing at a federal level, they would just have to pay 15% long-term capital gain tax, which results in a $6,000 tax liability. Instead, we implemented the following strategies to move the $40,000 of capital gains into the 0% tax rate. Once they received the sale proceeds from the house, we had them deposit that money to their checking account and then go to their employer to instruct them to max out their 401k pre-tax contributions for the remainder of the year. Since they were both over 50, they were each able to defer $31,000, total of $62,000. They used the proceed from their house sale to supplement the income that they were losing in their paychecks due to their higher pay tax 401k deferrals. Not only did they reduce their taxable income for the year by $62,000, saving a bunch in taxes, but they also were able to move a full $40,000 in long-term capital gains income into 0% tax bracket. Here's how the numbers work. Adjusted gross income AGI is $110,000. Pre-tax 401k contributions were $62,000. Then less standard deductions were $30,000. And then total taxable income was about $3,100. In this case, $30,100. In this case, they would just they would be able to realize 66,600 in long-term capital gains before they would have to start paying the 15% fat tax on that income. Since they were below that threshold, they paid no federal income tax on the 40,000, saving them 6,000 in the $6,000 in the fat taxes. So, what is the filling the bracket in this case? The strategy that I just described is called filling the bracket. We find ways to reduce an individual taxable income in the year that long-term capital gains are realized to fill up as much as that of 0% long-term capital gains tax rate that we can before it spills over into 15% long-term capital gains rate. So for more good news, it's not an all or none calculation. If you are married and you have $60,000 in taxable income and $100,000 in long term capital gains, a portion of your $100,000 in capital gains will be taxed at the 0% rate, with the majority tax at the 15% tax rate. As you might have guessed, the IRS is not going to let you get away with paying 0% on the $100,000 in long-term capital gains because you maneuvered your taxable income into 0% capital gain range. But in this case, $36,700 would be taxed at 0% long-term capital gain range, and the remainder would be taxed at the 15% long-term capital gain rates. So this was all about the video. Hope this video will be very helpful for you. So do like and subscribe my channels for more informative videos.